Private money equity tends to be very similar to the private money lending. It's usually a similar type of investor that's local, that understands the market, that can be somewhat friendly-ish and easy to work with from a red tape perspective. Another positive of raising money as equity as opposed to debt is sometimes, not always, but sometimes you can structure the transaction to get 100% financing. You can get this in the lending world, but it's more common, I would say, from an equity perspective, where based on how you structure the deal and the ownership of the entity, your responsibility could be to find the deals, to manage the construction, and your private equity partner's responsibility could be to come up with all of the money. So when you're structuring these deals, again, as equity, it's oftentimes similar type person, but how that capital gets formed looks a little bit different, as does the return profile, as does the risk profile, frankly. Some cons of the private money equity are very similar to the private money lending, right? So there can still be some limitations on ability to scale, which again is a function of how deep the pockets are and how large your network is. There can also be that loan to own, strategy of that partner, particularly if they're going to sit in the equity stack. Hands-on nature of it, right? Again, something that you're going to have to be careful with. The other kind of probably big con relative to private money lending is if you're doing private money equity, if you're raising capital as equity, this oftentimes can be more expensive than debt, right? So if, let's say, you structure a deal where you're going to split the profits 50-50 and you knock it out of the park and you make $100,000 on the, let's say, a fix and flip, $50,000 of that's going to go to your capital partner, $50,000 that's going to go to you. For example, had you structured that as debt, maybe that the way the interest rate was set, that debt would have only cost you $20,000 or $30,000. Now you gave up a little bit of the upside by structuring it as equity. Again, pros and cons here. You can oftentimes get more capital, so you don't have to have maybe any of your capital into the deal, but you're likely going to be trading off some amount of the return as a function of that investor taking additional risk.